How is everybody doing today? Anybody want to get on camera and say hello? Oh, is it Daria or Daria?
It's Daria.
Awesome.
What's up, Troy? It's Josh Dawson. I'm driving back from Port Clinton, so I'll be listening to you in the car. You won't get to see my pretty face.
Oh man, disappointing. All right,
Thanks for
cool.
having me.
Yeah, thanks for jumping on. We'll give ourselves a couple minutes of realtor time here and then get started, and people can jump in as needed here. I'll go ahead and share my screen. All right, anybody have anything pressing, anything like super crazy going on in their market right now that you guys want to talk about here while we wait for another minute or two? Why don't you, if you're on here and not from Central Ohio, which I think most people actually are not, which is fun, why don't you throw in the chat where you're from, and then maybe market kind of neutral, up, down, or, getting better, getting worse. I'd just be curious, location wise. I think it's always good for us to know kind of what's going on in the market.
I'll just chat about it if you don't mind.
Yeah.
So we're in the Raleigh market, definitely growing market. However, starting to stabilize in certain price points. And then just recently today, doing a check-in with my agents from the weekend, we had multiple offers again going, 10, 20, 30,000 over ask and high amounts of due diligence again. In our state, our due diligence goes right to our sellers. So upwards to $20,000, $30,000, $40,000 right to the seller.
Wow.
Yeah.
That's good. Who else? Go ahead. And if you don't want to jump on and talk, put it in the chat in terms of where you are and kind of what the market's looking like. But anybody else that wants to jump on, we can go through a couple more. If anybody else wants to talk. Everybody's super talkative today, huh? All right, well, I'm going to go ahead and jump right in then as a few more people jump in. For those of you that are just joining, I'd love for you to put in the chat where you are and what your market's looking like. But I'm going to go ahead and jump into the slides I've got. So what my goal is today is to kind of go through these categories. So I'm going to go through inventory and selling trends, which for those of you that have been on this call before, I kind of do every month. And then I've kind of labeled a couple slides clickbait versus reality, because I think the media is having a heyday with some of the percentages. And then I want to talk about really what they mean and put them back into reality a little bit. Touch on inflation, which we've done over the last couple months, but just giving you kind of an update and where that stands, and then roll that into the Fed funds rate versus long-term rates. I think when we talk about being the local economists of choice, if there's one thing that I think that we should be able to explain as agents is why did the Fed funds rate get raised by 0.75% last week and interest rates for mortgages actually went down. So I'm going to talk and kind of explain my interpretation of much smarter people than me, explanation of why that is. And then I always like to kind of go through the market of the moment with regards to, are we setting any benchmarks that are looking like 2008 all over again, or do a lot of the things that we've talked about in the past still remain the same? And then my newest one, which I'm just going to touch on a little bit, is the Wall Street and corporate buyers and what is their impact on the market. For those of you that don't know me, I guess I should probably put a slide in here just to quickly tell you about myself. But I've been a real estate agent since 2004, so I did live through 2008, survived. I'm in Columbus, Ohio, and I have been a team leader for Keller Williams, and then I also am now back to selling myself and also running my team. I own quite a few investment properties personally, and then also do some coaching. And then I guess the last thing is I just opened up a construction company. So I've got a lot going on, but numbers and the market is kind of a passion of mine. And so I started doing this here within our office locally. And then Dana asked me to start doing it on the one team kind of network. And so here we are. So I've been doing this for a few months. So it's usually the second or third Monday of the month that I do this. So definitely keep an eye out if what I've got is valuable. Also, if you want a copy of the slide decks, please email me. I'm going to put my email in here and I'll have my assistant get that over to you. If you want a copy of these slides. So jumping right in into the market. So active inventory, active listing count is up, as you can see. It's still not anywhere near the 2019, 18, 17. So even though we're up by 30%, I didn't identify this as a clickbait moment, but it definitely is. That 30% number sounds huge, but when we look at where we were last year, we were so far below normal that it's actually still, when relatively speaking, we're still in a very, very strong seller's market. And it's interesting to hear about the multiple offers kind of coming back again, and we'll get into that in a minute. But I think a lot of people are seeing that, and my prediction is that we will probably begin to see that again if all of the trends remain the same. I do, from an inventory perspective, like to point this out, and I know I've had this slide for those of you that have jumped on here before. This is looking at just the Columbus market, but one of the most interesting things I've found when researching over the last couple months in terms of looking at inflation and different things, the number of available homes back in 2004, 5, and 6, all the way through 2008, then again, due to foreclosures, and our market was much, much higher back then than it is now. And so I think that's one of the biggest differences between now and 2008 is we were coming into 2008 with a number of other headwinds in terms of credit worthiness of people that had bought properties. But the biggest thing that we were running up against was inventory. We were really starting in 2006, starting to really level up in terms of the active listing count. And especially compared to the solds. If you look at this, in 2006, we listed in Columbus, Ohio, 51,000 properties for sale and only sold 50% of them. You compare that to, this is mislabeled, you compare this to last year, we listed 39, just under 40,000 properties for sale, and we sold 36,500. And so it's just a massive difference in terms of the available inventory that's out there. And so I think until that problem is solved, a lot of these numbers that we're going to talk about there's going to be a long ways to go before we get anywhere near 2008 in terms of inventory levels. That being said, one of the things that is dropping compared to the last couple of years are pending sales. In my opinion, some of that is definitely the slowdown in the economy, but the other reason that is that we just haven't had the listing inventory. So many places in the country all throughout this year did not have the listing inventory. I think pending sales, we're starting to work through some of those new construction properties that have been listed as pending for a while. But we're still, in terms of the pending listing count, still above everything pre-pandemic, which is something that, from my research and then also just looking at reality, we went through the lowest amount of inventory. I mean, last year and into the beginning of this year, we were at the lowest amount of inventory we've ever seen ever. And 2019, 17, 18, and 19 were still really strong sellers markets for most markets throughout the United States. And we've gotten used to comparing year over year numbers because they've always looked better. And now we're freaking out over year numbers. But in reality, when we put it into historical context, we're still in a really good position. And you can see that even though being down 19% compared to last July, we're still well above those previous 3 years. Newly listed homes, we were kind of trending up on that, and there were a lot of experts that were really raising the warning bells around newly listed homes, because last month we had trended up above that 2017 level, and everybody thought that every person in the US was going to go try to put their house on the market at the same time so they could maximize their value. But one thing I heard on a podcast I was listening to yesterday, and I've got some specific numbers further in the slide deck, but is that most single family homes in the United States are occupied by their owners. And that's a key fact, because the reality is that even if somebody wants to sell, even if they desire to move, they still have to have somewhere to move to. And the active listings are still really low in almost everywhere in the country because of the perception that there could be a massive slowdown. The builders have pretty much stopped building new houses, and they're somewhat freaking out to try to get rid of their existing inventory. And so we really are putting ourselves in a situation where we're actually not going to have inventory, and we might even be putting ourselves further behind, especially if what's happened over the last 2 or 3 months becomes kind of a blip in the radar and things start trending upward again after this. So again, we've seen that trend line adjust in July. We'll see if that continues in August. But if the trend line starts to go down, we're going to put ourselves right back in the same situation. So for those of you that haven't been on here, since I'm from Columbus, I have access to a lot of local market data. So I do throw that in here, and it looks like I forgot to change this. These are the July numbers, not the June numbers. So I apologize, I mislabeled that. New listings are down 20% compared to last July, which again, we're seeing the same thing that the national numbers are showing. Active listings up 23%. Solds were down. And then also pendings were down just a little bit. Pendings, though, that this is like the first month that pendings have been down. And so that is a key indicator for me that we definitely have seen the slowdown. Those of you that are in the market have definitely felt that. But if we continue to see new listings stay lower than last year, we're going to be back in the same problem. So here's one of the clickbait versus reality points. So if we look at last July, the average days on market was 10. And this is in Columbus. If we look at the average days on market for July of this year, it was 12. So that is a 20% increase in average days on market. But when we look at reality, it's 2 days. How many sellers are impacted drastically or in a really major way by something taking 12 days instead of 10 days? And obviously this is on average. So I think we have to put the increase, these percentage increases or decreases, depending on what number we're talking about, into perspective. And I think usually when you see articles written, they use these huge percentage change year over year numbers, and it's just not bringing things into reality. One interesting thing, this is the average sales price compared to the original list price. And we see that we're still above 100% as a market average, which is pretty interesting. When we put local or average days on market into perspective, this is the last 5 years. And when we look at July over July for the last 5 years, we can see that, again, outside of last year, we are still almost half of what we averaged from 2018 all the way through 2020. Local market supply, again, the amount of properties, months of inventory available is up 44.7% or 1 week. So again, keeping in mind, what does that number actually mean? Remember, 4 to 6 months of inventory is a balanced market. So I think most economists would probably like to see about 4% or 4 months of inventory. that would kind of start to level out the seller versus buyer market. And right now we're still only at 25% of that. So we still have a long ways to go. Days on market, again, I had talked about the local, but actually the time on market nationally was down 2 days compared to last July. So still well below the past. Median list price, definitely things have begun to flatline, which I think most of us were predicting, while many others were predicting a pretty big decrease. But if you look at years past, that's fairly normal. Typically, we see the largest amount of appreciation in a given year during the springtime. And ironically enough, if you guys do pay attention to numbers, which this isn't like, hey, this is a reason to sell your house in December. But actually, if you look at this between November and December, the average price in every other year, and even last year, it does go down. So usually dips in kind of December and January and then comes back up, and in most years goes up higher than it was last year. So we're still up 16.6% year over year. The market seems pretty stubborn to give those gains back. So we'll continue to see what that looks like as we move through the year. In Columbus, we're a little bit below the national average in terms of increasing. But again, this is also average compared to median, which is we don't track median in this data. So we see the first 2 weeks of August were up 8% for the sold properties compared to last year, and actually compared to July down about 2%. But that could also be just having a few of the big sales not happening in a specific time frame. So still year to date though, up 12%. Price reductions, definitely a trend. So I'm sure we're seeing it in our market for sure compared to what we were earlier in the year. I'm sure everybody is to a degree. I know some of the places like Austin and Nashville, some places in Florida, Phoenix, some of the really, really hot markets have been seeing this at a much faster pace. But again, plus 9% in terms of the number of people that are doing price reductions. Again, putting it into perspective though, historically, look at 17, 18, and 19. We're right kind of in the middle of that. Now, if we shoot above those trend lines, then that's, again, something that we need to keep an eye on. Certainly, this trend line is hockey sticking up. So if that trend continues, we could be looking at something. But as Darius said, in Raleigh, we actually are moving in the other direction now, where we're getting multiple offers and going over list price. And I've been seeing that as well here in Columbus. Interest rates, they've definitely been the talk of the town, I guess, for this year, for sure. Again, like we've said several times, we saw a pretty big increase. But one thing that's happened here over the last 3 months or so is we've seen things pretty much stabilize. We saw that bump in the middle of June, which caused everyone to freak out that we were on our way to 9, 10, 11% rates. But they've really stabilized since then. And other than that 1 or 2 week period in the middle of June, we've actually seen them pretty much settle into that 5 to 5.5, 5.75% over the last 3.5 months or so. And in my opinion, that stabilization is one of the reasons why we're starting to see multiple offers again, because basically people's budgets aren't being blown on the weekly basis as rates go up. So again, if we look at what rates were at the beginning of the year versus what they were as of Friday, and this is national average. So obviously I know here in Columbus, usually we're a little bit below, or sometimes a decent amount below the national average in terms of our local lenders. But you can see, I mean, a $600,000 mortgage, you're paying $740 more per month today than you were in January. So that's a big deal. But I do think that overall, historically right now, we are really not seeing rates outside of what the historical average is. So we all got spoiled with 2 to 3.5% rates. But the reality is that's not reality. The Fed would like to see rates stay right around 5%, give or take. And so really the range that they're in right now is historically where they like to see them. And so it would be they've all but said that they're not planning on doing any kind of assistance with regards to mortgage rates anytime soon. And I wouldn't expect that rates are probably going to go significantly below where they're at right now, barring a really major recession, which we'll jump into in a second. So Fed funds rate versus long-term rates. Anybody want to take a stab at what the differences are and why they happen? And if not, it's okay. But if anybody is like an expert on this, I'd love to get your input. I've got my notes here, but yeah, anybody want to take a stab at Fed funds rate, which is the one that, you know, makes the headlines in terms of the Fed raises interest rates by 0.75 versus the long-term like mortgage rates. Don't everybody talk at once. All right, I'll jump into it then. So the dual mandate of the Federal Reserve, which are the ones that control those interest rates, is number one, to maximize employment. So their job is to get as many people working in the US as possible. And their number two mandate is price stability. Obviously, inflation has completely blown number two out of the water. Employment has actually been some of the best it's ever been. So they've been, you know, patting themselves on the back for that, but price stability or inflation has definitely been a challenge, and it's really out of control. And so, but the strong employment makes the Fed feel more confident in raising short-term interest rates. The whole goal of the short-term rates going up is to really slow the economy down. So like I said, last week, the Fed raised rates again by 0.75%, but then the mortgage rates dropped. And the reason for that is again, because the Fed funds rate is used to slow down the economy when they're raising rates. When they want the economy to do better, when we go into a recession, they lower rates. And so slowing down the economy, the goal of it is to slow down growth, and therefore would, in theory, cause companies to make less money, potentially cause them to lay people off. And therefore, it could lead to a recession. Now, there's been a bunch of talk about, you know, are we currently in a recession? Are we not in a recession? And I think for purposes of this discussion, it doesn't really matter. The point is that long-term rates, when they see the Fed funds rate going up, which again, the stated goal is to slow the economy down, they think there's a higher chance of recession. When there's a higher chance of recession, the big traders that trade on Wall Street tend to sell stocks and buy bonds, which pushes down the return on those bonds, which causes long-term rates to go down. And so I know that that's somewhat deep, but that was about the simplest I could get it. So when we see those rates going up, we're going to see those short-term rates going up. We typically are going to start to see the long-term rates push back down the longer the Fed basically says that they're going to keep raising rates, which most people bet will push us into some sort of a recession. Now, recession doesn't equal 2008 housing market, but it could equal a slowdown in the overall economy, which again means lower rates. That being said, we did see this year having one of the largest increases, and we already looked at that. Inflation. So this is the whole reason why the Fed funds rate is going up, and that is to slow inflation. And we did see for the first time really this year a decrease in the inflation for the month of July. Those numbers came out last week. So the headline number is the CPI, which basically puts everything that we buy into one number, and that dropped to like 8.6 after going above 9 in June. And then the core inflation, which excludes energy and food, that also went down. So that's good, because some people would say that, just because gas prices went down, that's why inflation went down, but also the things excluding gas and food also went down. So that is what they want to see. The Fed has said that that's not enough to stop increasing that Fed funds rate. So I would expect to see more increases on that as we move through the year. And then probably, come mid to late fall, they'll probably start to, they'll be looking at what that impact is and continue to decide. So when we talk about being the local economist of choice in our market, the biggest question that I'm being asked, and I'm assuming most of you are, is will this be another 2008? And I really, really don't think so. And a lot of people that I really respect that are much smarter than me don't believe so either. And the biggest reasons are these 5 right here. There are a million other reasons why I think it's not 2008, but these are the top 5. Most homeowners have a massive amount of equity, meaning, and so what does that mean? That means that if they were to lose their job, which is the primary reason why foreclosures happened in 2008, they have a lot of equity. Home equity lines of credit have not been nearly as popular as they were in 2005, 6, and 7, where people were tapping in and spending their equity on boats and all kinds of different things. And with interest rates having popped up, it's actually calmed people down in terms of doing cash out refinances. So long and short of it is we've seen massive appreciation in a short amount of time, and most people have not spent that equity unless they've sold. Number 2, if you sell your house and you don't go buy another house, then you have to rent something, and rental rates in terms of monthly payments have increased exponentially as well. And so because of that, it's made the idea of selling your house, taking all of that money, not as attractive, because if you have to go rent something and pay as much or more than your mortgage payment was, who would do that? Credit worthiness, or the types of loans being given. Back in the early 2000s, 20% of all mortgages were going to subprime borrowers. And that simply doesn't exist right now. With some of the legislation that was enacted after the crash in 2008, we've just seen a very, very overall conservative lending approach from Fannie Mae, Freddie Mac, and even the lenders that lend to people outside of the Fannie Mae and Freddie Mac guidelines. Even the ones that seem extreme, like bank statement loans and different things like that, you have to put a lot of money down. You have to have good credit. There are a lot of things that exist that were not in place in the mid 2000s. Inventories remaining at historical lows, probably, in my opinion, the number one reason why we just won't see a massive fallback in prices. And then the last thing is most homes are occupied by their owners. They have to live somewhere. And if they have to live somewhere, they're not going to sell their house that has a bunch of equity and a 3% interest rate to go rent somewhere or buy a smaller house for the same price. And therefore, I think the worst case scenario for the market is that we just have really, really low inventories until the economy bounces back. This is more of a snippet. It really honestly doesn't fit into any of that stuff that I just talked about, except for maybe inventories. I've heard rumblings, and to be honest with you, I kind of thought this. I know on a percentage basis, especially last year, there were a lot of Wall Street companies, hedge funds, and actually BlackRock just announced that they have a $50 million fund that they're going to be prepared to go buy more residential real estate. And so a lot of people have speculated that all these corporations own these houses, and therefore the housing market is at risk. Well, one thing is that the corporations want to own them long term. For them, this is a very long game. And so I don't foresee, based on everything I've read and researched, I don't see them selling massive amounts of these all at once, because they are hurting themselves, right? If they sell the one at 123 Main Street and then for a deep discount, then the one that they own at 124 Main Street has now dropped in value. So they're kind of shooting themselves in the foot. But the other interesting statistic is that these companies only own about 0.3% of all residential single family homes. And actually, even of all the rental properties, rental single family homes in the US, they only own about 2% of those. So their ability to impact the market in a major way is just super small. Not to say that it can't get that way at some point down the road, but right now, just don't see that happening. So for those of you that have asked me before, sources, I love mortgagenewsdaily.com. Maybe someday they'll give me a plug or something because I scream their stuff from the mountaintops. They send out a daily email with just mortgage updates. I really like their information. They include a bunch of other information in there about the market, whether it's home building, whether it's the inflation. A lot of the graphs that I showed here came from there. So definitely check it out and do that. Realtor.com does do a good job of displaying all that national data. And then the local stuff that I got was from Trend Graphics. So that is all I've got in terms of my slide deck. Does anybody have any questions, comments, any conversation that you guys want to have before we jump off? No? All right. Well, if nobody has anything else, thank you guys for jumping on. All right, Cindy, what are you seeing overall in Columbus? Well, I think as mentioned earlier, every market and submarket are very different. And so we're definitely seeing different communities see different things. And then also in price ranges. I would be curious to hear from everybody else that might be on this call if you have an opinion on that. I think that Columbus overall is really strong. There's a number of reasons. I think supply and demand is the biggest reason why we're unlikely to see a fallback in prices. I think that's true across the country as well. Here in Columbus, we also have Intel that's bringing 3,000 jobs themselves. And the last place that they opened up or did a semiconductor fob was in a town in Arizona. And when for every job that Intel brought, it brought 13 additional jobs. So with 3,000 jobs coming to Intel, that math says 39,000 additional jobs to our market. And that is going to be a pretty big strain on supply, especially based on current levels. So I feel very bullish about Columbus. The only other thing I'll say from a script perspective that I think is super valuable when we're talking about the market and what's going to happen, because frankly, none of us know exactly what's going to happen, especially on a timeline. But the number one thing we need to be asking our buyers is, what is your timeline? How long do you see yourself living in this property? And I would say in general, for most areas, if they're planning on living there for 3 to 5+ years, then I would strongly encourage them to buy. I think if somebody is for sure moving in the next 2 to 3 years, it's definitely a risky proposition to buy a home because of the fact that we do not know whether we're going to go into a recession, and if we do, how deep it's going to be. If we see unemployment rise in any significant way, it certainly will lower demand and therefore could cause prices to stay pretty flat over a period of 1 to 2 years, potentially, if the recession were to be strong. And that alone, remember, it in most instances, once you factor in title fees and real estate costs and all of that, I mean, I think the range is going to be somewhere between 5 and 10% in terms of an overall cost of sale. And so you have to see 5 to 10% appreciation just to break even for the average consumer. And so if we see a flat pricing over the next 1 to 3 years, just due to things that naturally can happen, that could cause it to be not the best decision. But I think for most people feel pretty confident that 3 to 5+ years that things are going to be looking good. And I know personally, my goal is to buy as much real estate as I can over the next 6 to 12 months, because I believe my play is very long term. And I just believe that right now, any slowdown that we're all feeling in our local markets is going to be relatively short-lived unless we see massive unemployment increases. And so I think we may all look back at this summer as one of the best opportunities to buy in our markets. And it may go into wintertime just because that's normal seasonality, but I would fully expect, without major unemployment, that next spring will be a typical spring market and maybe more closely resemble what we saw last spring if we don't see more inventory coming online. So I see Stephanie on here. I don't know if there's anybody else that works intimately with builders. I would love to get your feedback on what the conversation is like behind closed doors. You don't have to say which builder you work for or work with, but I'd love to hear what the conversation is behind closed doors, because I think if there are any builders that are willing to like put themselves out there and keep building during this, they could be putting themselves in a really great spot, and they could look really smart next year. Anybody on here that wants to be brave? Come on, at least one of you guys has to be brave. I mean, you guys have been really quiet today. I'm going to make everybody turn their video on next time. No one? Stephanie? Are you here or just listening? We're going to keep on pushing forward. Yeah. I really, really think that it'll be a huge mistake for builders to really slow down in a significant way. But if nobody is going to talk, then I guess we'll just all go. You guys have an awesome day, an awesome week, and an awesome month. Like I said, remember, if you want the slide deck, just email me and I'll have Kayla shoot it out to you. So thank you guys for coming, and we'll talk to you next month.
Thanks, Troy.